Good morning and welcome to the latest edition of Service Wealth Matters, a complimentary presentation available to Service Credit Union members and non-members. Our agenda for today, first we'll be going over what is financial planning. We'll be talking about investing in real estate, investing in market portfolios, factors to consider for both, pros and cons of both. And then we'll go over some offers and door prizes, and there will be some time at the end for Q&A. A few disclaimers. The information contained in this presentation was obtained from sources believed to be reliable. However, we cannot guarantee that it is accurate or complete. This report is provided as a general source of information and should not be considered personal investment advice or a solicitation to buy or sell any mutual funds or any other securities. In support of Ukraine, Service Wealth team of Southern Alberta will be making a donation to Canada-Ukraine Foundation to help with humanitarian relief for those affected by the war in Ukraine. Donations from advisors will be gradually pooled after each webinar and of our free 2022 Signature Wealth Matters webinar series. And we also like to thank Southview Church in Calgary for their donation of $250 to the Canada-Ukraine Foundation on behalf of Service Wealth Strategies.
My name is Stephanie Greenoff. I have been working for Service Credit Union since 2017. Background in retail, mostly mortgages and lending, and now I am working as an investment specialist, focusing on holistic financial planning with my members. Just kind of a high-level introduction about financial planning. What is financial planning? So really, we are looking at 6 different areas of your financial picture. First of all would be financial management. So that's sort of your day-to-day cash flow, spending, making sure that any debt you have is sort of in the best possible setup for you. Investment management would be kind of making decisions around what are the best investments for you to hold, what types of accounts to hold them in, and making sure those are really aligned to your goals. Retirement planning is a big one. We want to make sure that someday, if you wish, that you have the ability to stop working or reduce working, and you have the financial freedom to do that. Risk management, no one likes to talk about, but we want to make sure that you are protected if something unexpected were to happen. So estate planning as well, we want to make sure that your wishes are fulfilled, that your legacy is true to what you wanted to achieve. And tax planning is a big one as well. We're not tax professionals, but we always want to make sure that we're keeping tax implications in mind for all of these different aspects and making sure it's the most efficient for you. We know that finances can be a really big cause of stress for people in their lives. And sometimes it's just a matter of not really knowing where to start or what to do. So working with professionals like ourselves, we can help you come up with a plan so that you have a clear picture of, how you're going to reach your goals, what tangible steps you can take to get there. Ultimately, helping you sleep better at night because you know that there's a plan in place.
Hi, I'm Tazim Azaria from RE/MAX Realty Professionals. I've been a realtor since 1993, so over 28 years, servicing Calgary and surrounding areas like Airdrie, Okotoks, Chestermere, Strathmore. So, real estate, as defined by Wikipedia, is property consisting of land and the buildings on it, along with its natural resources, such as crops, minerals, and water. As we know, we have a limited amount of land. It is finite. Any commodity that is limited retains its value at the least and appreciates over time. As we look at graph 1, we see how over the years in Calgary, the prices of single-family homes have appreciated. The average price of a home in January 2013 was at $450,000. It has steadily risen with a few dips related to the oil and gas industry, changes in qualifying criteria, and for a very short time during the pandemic. Today, the average price of a detached home in Calgary is just over $640,000. In the apartment condo sector, as we see on the second graph here, we see wider fluctuations in prices, where our average price was at $240,000 in 2013. With more new apartments being built and with layoffs in the guest and old sector, prices dipped for a short time. Today, we are seeing a recovery in this sector, and prices are on the rise for the apartment condos. Looking at graph 3, where we see values of detached homes that have sold since 2018. Our highest value was in April 2018. 2021, since 2018, our highest value was in April 2021 with $200 million in sales in a month. So lots of zeros there. In February of 2022, we were already at that number and we keep selling. In the apartment sector, we have far surpassed the volume of units sold since 2018. Are we in a buyer's or a seller's market at this time? Well, a buyer's market is when we have a supply of over 5 months. A balanced market is 4 months to 5 months of supply. A seller's market is when the months of supply is below 4 months. So let's look at these graphs here. In July 2017, when we had a fairly strong market, in the detached sector, we had just over 3 months of supply for single-family homes, and that put us into a seller's market. In the attached sector, we had 3.5 months of supply, which again puts us in a seller's market. The townhouse condo, we had 4.78 months of supply, which put us in a balanced market. And then in the apartment condos, we had 7.5 months supply. So that put us in a buyer's market. As we look at February 2021, at the end of February, in the single-family homes, we had just over a month's supply. So that put us in a seller's market. The attached market was just under 2 months. So that again, that was a seller's market. The townhouse condo, just over 2 months supply, was again a seller's market. Apartment condos was a buyer's market with just under 6 months of supply. That has changed significantly as we look at the stats for March 2022. In the detached market, we have just under a month's supply, and we are selling over 2,000 units per month. In the attached, we have less than a month's supply. In the townhouse condos, we have less than a month, seller's market. And the apartment condo market has really picked up. We are at just over 1 month's supply. So we are in a seller's market for single-family homes, detached, and apartment condos. So where is this demand coming from and why? It's both local and international. Families have adapted to working from home and studying from home. As a result, they need more space at home to designate as a work area as well as a study area. This has driven up the demand for single-family homes. Secondly, subsidies given to people during the pandemic gave them the opportunity to save for a down payment. With travel restrictions, restaurants and bars and pubs being closed, places of entertainment were closed, as well as working from home made it possible for people to save on parking, travel expenses. So that again, they were able to save some money and have a down payment available. Thirdly, interest rates are still relatively low. People who are living in condos downtown so they could be close to work, and their offices were downtown, are now able to work from home and therefore do not need to live in condos downtown. When they factor in the condo fees that they were paying as well as the mortgage payments, they are now able to afford a single family home without a significant increase in the monthly payment. Another reason that's driving this demand is migration from other provinces as well as from the US and China. With businesses being able to operate, having employees work virtually, we are seeing families moving in from larger cities like Vancouver and Toronto, where housing prices are much higher than in Calgary. As well as this, we're seeing investors cashing out of Toronto and Vancouver. And we are seeing a lot of money coming out of China, where investors are seeking a safe haven to invest in hard assets versus currencies as inflation protection. How can one buy real estate? The minimum requirement for an owner-occupied property is 5%, provided, of course, you meet the qualifying criteria such as being employed. This 5% can come from your savings or can be gifted. Or you can also use your RRSPs towards your down payment. For an investment property, you would need a minimum of 20%. And of course, one of the service mortgage specialists would be happy to help you. Other costs associated with house purchase are home inspection, which is typically around $500. Condo document review. If you're buying a condominium, you need to have your documents reviewed, and that's about $400. Lawyers' fees are running at about $600, plus the cost of registering the mortgage, disbursements, and GST. And of course, you have moving costs. You need to insure the property. You need property taxes for whatever you're buying. Real estate fees are typically paid by the seller. So as a buyer, you do not pay any fees to the agent representing you. Finally, why is real estate a good investment? Owning a piece of real estate allows you to borrow money against it, provided, of course, you meet the criteria from the lender. On a revenue property, the interest you pay to the bank for the mortgage can be shown as an expense, thereby reducing your taxes. In the meantime, a good portion of that mortgage is being paid by rental income from the tenant, and you're building equity in the property. Buying real estate when interest rates are low allows you to keep inflation at bay. If you're printing more money, the existing money is losing its value through dilution, whereas we can't print any more land. And then there's a principle of leverage. With 20% of your money, you can buy 5 times as much in the amount of property. For example, if your property is worth $100,000, you can put 20% down, but you cannot buy any stocks with 20% that are worth $100,000 with $20,000. So those are a few benefits of investing in real estate. Thank you.
My name is Larissa Trajanowska. I am an investment advisor at Service Credit Union, which I like to call a senior financial planner. I'm going into my 9 years at Service, about 10 in the industry in general, for which I'm really grateful and passionate about. And today we'll be talking about investments in tangible real estate and market portfolios that are professionally managed and may contain real estate in them too. So to start off with some facts, I would like to point out just day-to-day regular things that we are all kind of aware of, but put in numbers helps. So starting with your primary residence. According to Statistics Canada, as of 2019, a principal residence was one of the largest assets for Albertans. In fact, it was accounted for more than a third of total assets that a person has in Alberta, about 42%. Other real estate, such as cottages, timeshares, rental properties, and maybe commercial properties, represented about 10.3% of total assets. if we're looking geographically, we live in Canada, we work in Canada, we have our properties in Canada. And where do we stand from that point of view? So the Canadian market represents less than 4% of total capitalization in the market. But at the same time, average Canadian holds about 92% of the assets in Canada. So if we were to look at potential risk you may have by being in Canada, living in Canada, working in Canada, having your principal residence and maybe other investments here, what if something were to happen to your employment or just to Canadian climate in general, like in 2014 when things were slowing down a little bit? Should you maybe have some diversification outside of Canada? And this is what we would like to consider when we talk about investments outside of your principal residence. So investment world has a vast number of options to consider. There is a whole ocean that is, you can find whatever you like, whatever fits your preference and your values, most importantly. But as we always stress, the investment choice has to fit your financial plan, your goal. So knowing what your plan is, knowing how it wraps around your goal, which your goals will be very different from somebody else, we can make a recommendation based on investment portfolio. Narrowing down from a point of conversation from real estate, I would like to talk about some investment solutions that have real estate exposure, so you have a fair comparison of tangible physical real estate versus maybe a more diversified portfolio that has real estate in it. So let's start with a mutual fund. What is a mutual fund? We all have heard it, we all have seen commercials. Well, what is it? To simplify a little bit, mutual fund is an investment vehicle, and the way it works is maybe I would like to buy shares of different companies and each share costs over $1,000 and I don't have $1,000 for each one that I would like to buy, so does it mean I cannot invest? Well, what mutual fund does is trying to help in that case. So maybe I want to invest, my friend wants to invest, my realtor wants to invest, and we pull the money together and jointly it becomes a mutual venture, if you will, to buy into a portfolio. And that mutual fund is a pooled solution from everybody who would like to participate that allows you to buy cost effectively multiple investment solutions in that portfolio. So you will have really well diversified from country point of view, from type of an investment, from any kind of sector. Should it be real estate or energy or financials? It will be diversified. And it's an easy way to enter because it doesn't cost a whole lot. It's a pooled effort from numerous people and it's a mutual fund. So a mutual fund usually will hold securities such as stocks, bonds, money market instruments, and other assets. We're talking real estate, so I'm going to narrow it down even more on examples of real estate in a mutual fund. So you may have heard of a real estate investment trust, REIT for short. That is, a REIT is a company that owns and in most cases operates income-producing real estate. Some of examples could be that REIT may own different types of commercial real estate. For example, office and apartment buildings, warehouses, hospitals, shopping centers, hotels, timberland. Hospitals, I'm just going to briefly speak about. It's pretty obvious. High occupancy usually is in the hospitals, and vacancy rates are low, and usually it's a pretty long-term commitment. So you will have most likely some stability from real estate point of view and ease of accessing that investment in a portfolio or in that investment security, which it may be hard to buy a piece of hospital if you were to go and do it on your own with cash. So some flexibility to have real estate exposure through a portfolio that can be more diversified and quite easily accessible from a purchase point of view. I would like to stress, as I started saying, that mutual fund is not the only investment solution. There can be other ones. Talk to your financial planner. Your financial planner will guide you with what the best solution is for you based on your goal and your plan. It could be a portfolio that has real estate in it. It could be individual real estate investment trusts. It could be maybe something more unique, like maybe more of a private, non-public investment that has direct ownership in securities that are real estate. Same idea, warehouses, offices, hospitals, shopping centers.
Just a high level overview of some factors to consider with both investing in property or investing in market portfolios. With an investment portfolio, the minimum initial investment can be relatively low, as little as a $500 lump sum, or you can set up a recurring plan toward it for as little as $25 a month.
When getting into an investment property, the investment in terms of dollar amount is relatively high. You need a minimum of 20% for a revenue property.
As far as liquidity goes with an investment portfolio, they're generally quite liquid, meaning you can access funds out of your portfolio within a relatively short period of time, usually just a few days, to get that money out of that investment and back into your bank account.
If you're planning on selling a property at very short notice, especially in a buyer's market or when the economy is going through a downturn, you may have to reduce the price and you may not generate the profits that you had planned on initially. So it's an investment where you cannot sell a portion of that property. So you should really consider what your goals are when you're investing, and is this a long-term goal? Are you going to hang on to the property for a while?
You also have the option to sell just a portion of your portfolio. So it's not an all or nothing. If you have $1,000 invested and you only need $100, you can generally take out that smaller amount and leave the rest.
It's not a liquid investment, so it may take some time. It could take weeks to months to sell. And once it's a firm sale, possession or that closing time could be further along the line, and therefore during that time you're on the hook for paying property taxes, mortgages, insurance, and the maintenance of that property. So those are things, the utilities, all of that. So those are some things that you need to be aware of and factor into your investment.
So as far as costs or expenses go with investing in a market-based portfolio, for example, with a mutual fund, typically the fee you'll be looking at is called a management expense ratio, or an MER. This pays for the ongoing maintenance of the portfolio, the portfolio managers doing the work of deciding which investments to hold or sell or trade within the portfolio. And also generally it would include some advice that you're receiving from your advisor as well.
The costs that are associated with owning an investment property, one of those is the interest rates that may fluctuate. Yes, you can lock into a 5-term mortgage, but once that mortgage term is fulfilled, the interest rates may change. So you need to be aware that those costs do fluctuate. And you need to budget for potential vacancy in your property. So budget for about 1 or 2 months of not having a tenant there. During that time, you may need to do some repairs as well to the property. And of course, you have the associated costs with it, right? You can manage your own property, therefore you're investing a portion of your time managing, or you may pay a property manager, again, a cost associated, to look after it for you. The rental income in terms of your taxes, that's a taxable income to you. So you have to be aware that whatever revenue is being generated is now a revenue to you, and it's taxable. The dispositions can be taxed as income or capital gains as well for non-principal residents. So another thing that a non-resident of Canada investing into real estate should be aware of.
As far as tax efficiency within an investment portfolio, distributions can include interest, dividends, capital gains, return of capital. There's lots of different types of income happening within a portfolio. Depending on what type of account you're holding that in, you could have no tax implication or a deferred tax implication. If it's in a non-registered investment, you will have some taxes to consider. As far as getting effective diversification with an investment portfolio, there's relatively easy opportunity to do that. If you select, for example, just one managed portfolio, that's kind of just making one investment decision, and then you can have diversity across different asset classes, regions, and sectors, all with that one investment.
In terms of effective diversification, so if you invest in a condo as well as detached, diversify your investments so that if the rental market in condos is doing really well and detached isn't, then you're balancing that. So something to keep in mind, that this may be a factor to consider, and to diversify your investment in your real estate portfolio.
So just to summarize some pros of investing in an investment portfolio, one of the benefits is that it would be professionally managed full-time, meaning you don't need to do a lot of hands-on, monitoring of it. You kind of make the initial decision of what suits you best at that time. And then the professional managers are going to make sure that portfolio continues to align with your initial objective. So automatic rebalancing as well. If you are an investor who is saving toward a longer term goal and you want to have a little bit more growth opportunity, and your portfolio is more exposed to equities, for example, your portfolio is going to automatically rebalance to make sure that you always have that proper allocation of equities versus other holdings. Really effective diversification as well. So again, opportunity to just select one investment and have exposure to a multitude of different investments within that portfolio. A relatively hands-off approach, unless you choose to do it yourself. It's not something that you need to put a lot of work into. You don't need to be constantly checking on it, making changes. It's going to pretty much manage itself. There is a low minimum dollar amount required to get started with investing in a portfolio. And you can easily access a portion of your portfolio at any time, which could be considered a pro or a con, depending how you look at it. We always say, try not to panic depending on what's happening in markets. It can be really tempting to make a change to your portfolio at that time. Generally speaking, markets go up over time despite, fluctuations in the short term. So being able to access money and get out of your investment quickly may or may not be a good thing. And last but not least, both investment properties and investment portfolios tend to appreciate in value over longer term. So as we were saying before, regardless of what's happening in the short term, both could be really great long-term investment options.
Some pros and cons about real estate investment. It's a tangible asset you have, and you can choose to manage it hands-on or hire a manager. When you pay professional management fees, that is something you can use as a tax write-off against. That's an expense to you. You can refinance whatever your asset is, your property, you can refinance that, and therefore if you need to borrow some money against it, you could get money out of your rental property. Another thing to be aware of is the risk to physical damage to your property. So, although it is insured, there could be any damages. It could be hail damage, or a neighbor damaging it, or the tenant damaging it. So you need to be aware of and budget for that. And again, budget for any potential vacancies in that property.
So a few potential cons or downsides of investing in an investment portfolio. It's intangible. There's nothing that you can see, touch, or feel. It's sort of just this separate thing. So, there's nothing to really show for it necessarily. You do still pay fees regardless of what's happening in the market. So if there's short or midterm volatility and markets are down, you still have a fee to pay regardless. Last but not least, the news, headlines can often be a little unsettling. They like to talk about all of the doom and gloom in the world, and it can be a little bit scary in that you may think that your investment is the wrong decision or you should make a change. Again, we always say talk to your advisor. If you're feeling uncertain, we can talk through it and make sure that your plan still aligns with your goals.
If I were to summarize, I would always keep saying that financial plan is your starting point. Know your goals. Knowing your goals is really a miracle solution. It can prevent you from being greedy, jumping on an opportunity where it doesn't fit your goal. Oh, this is a great investment opportunity. I should get in and I will get rich fast. Well, usually with higher returns, there is a possibility of higher risk. Quite easy to get misled and blinded by that because you don't know what your goal is. If you know your goal and you know you don't need to be rushing through a high growth opportunity, then you don't have to chase it. So knowing your goal is your first step. Having a financial plan built around it is your next step. And everybody has their own passion. If this is not your passion, this is why we are here. We'll help you build the most logical way and most efficient way to get to your goal. And then we'll, as a third step, make a recommendation from what can be implemented in your financial situation, including an investment portfolio. Should it be an investment in a market or should it be an investment in a tangible portfolio? We'll help model and run comparisons so you know black and white. If I do this, that will be my long-term effect. If I do that, that will be my long-term solution there. And in some cases, you may need to have a tangible real estate property, in which case, talk to professionals in the industry, talk to your realtor. You probably will need to talk to an accountant, tax specialist, because if it's your investment portfolio that is generating income, well, there are taxes attached. So make sure you have a strong team of professionals cheering you on. And that doesn't mean just an investment solution. It means people who are helping guide you every step of the way, year in and year out. I could talk more, but I think I'm done.
I feel like clapping.
Wow.
I have several properties and I'm getting tired of managing them. I'm thinking of selling them shortly to realize the gains and transition to managed portfolios with part of the funds. Is this a good time to sell or should I wait?
This is a great time to sell. If you have revenue properties that you're not comfortable managing and you're ready to fold your tent, great opportunity to make money and retire.
If my retirement income is coming from revenue property, is my income better off by selling the properties and investing the proceeds, or keeping the properties and keeping the net rental profit?
It will really depend on what your goals are. If you're selling the rental property, what do you want to do with that money? You need to consult your financial planner at service and see where is the better opportunity for me. Do I diversify and where should I put this money? Or should I remain in real estate? Again, talk to your financial planner on that. What are the tax advantages of going with market portfolios as compared to real estate for investing?
That's a great question. Depending on what you invest in, as in which account you're using, you may have tax advantages in form of literally you invest within a more tax efficient account itself. I'm going to address the market portfolios first. I'm going to contrast with a real estate as the choice that you have available on the other end. So with a market portfolio, you could have it in an RRSP or a RIF portfolio, which is designed to help you grow your assets on a tax-deferred basis with an idea that in the future, when your income is lower and you're in retirement, you start accessing those portfolios, draw income from them, and then use it for your life and your goals. So if you have a portfolio that is growing within the registered plan, you don't face any tax consequences. It's just as simple as that. A cousin account, as they call it, is a tax-free savings account, a fantastic tool, has limitations because otherwise it would be too good to be true, with limits that the government sets out every year as to how much you can contribute. And same idea, you can have multiple investment choices within a tax-free savings account, no matter how much it grows. If it's an eligible investment that you have, which most professional managed portfolios are, that growth you have realized has no tax implications. And then you have a third option, which is regular non-registered investment, not RRSP or RIF, not TFSA. I'm leaving other accounts out for the conversation. Just regular growth in a portfolio. And in that case, when your portfolio grows, well, you have to pay taxes on that advantage that you're getting. Or if you're losing money, you may use it to offset gains in other investment vehicles, but there is a taxable implication. So from two components of a tax picture, if you have income that you're drawing from a portfolio that is growing, well, you will have to pay tax on that income portion. And then there is a growth. If you have a portfolio you bought for $10,000 has grown to $50,000, that's your growth of $40,000. If it's your capital gain portion of growth, half of it is taxable. Half is not. The other half you have to add it to your overall taxable income. And this is where we will always suggest you do work with a tax professional. We can work with your accountant jointly with you to make sure the whole plan is covered. But there are tax implications in short. Contrasting it with a tangible property you can own, what I just mentioned for a non-registered account applies. You have income, you will have to claim income on your income tax if you have positive cash flow. If you have losses, that's a different story. And from a principal growth of your asset, you bought for $100,000, you now decide to sell it later at $500,000. You have grown $400,000. Well, same idea, capital gain, 50% is taxable, 50 is not. So your taxable implication of $200,000 you have to include in your overall income tax amongst other income sources. You don't really have a choice to have a real estate portfolio within a TFSA account or an RRSP account. It's a tangible asset. It's not really a portfolio. From a point of an average person, how they manage their investments, that unfortunately is not as easily available as in a portfolio itself. Another piece is the fee. If you have any investment that is especially not guaranteed, somebody is doing something to help realize gains in the growth, well, you usually have to pay a fee for that. In a portfolio, depending on situation that you have and depending on the advisor helping you, you may have a way to have a fee in a more tax efficient manner when it can be deducted against the earnings in a portfolio. Not always, but sometimes that is the case, especially I'm talking non-registered account. Very similarly with a tangible real estate, if you have a fee that you're maybe paying a property management company for running the properties for you and looking after them, you can have this fee deducted against your earnings generated by the income in the portfolio.
Can I get regular income from my investments like I can from rental properties? As we continue with appreciation as well, continue with appreciation like the properties do?
Excellent question. Again, depending on your goal and on your plan, finding the best investment tool is your starting point. Depending on your overall financial situation, your risk tolerance, all the moving parts aligning from the efficiency of the overall plan, it is not unreasonable to have a portfolio that can help you fund your lifestyle through regular income. Whether it's timing of starting to access your RRSPs and RIFs in a most efficient manner time-wise within your plan or within your household plan, or if we're talking regular non-registered investments where you draw income, and if income is what comes from earnings, it's being taxable, there are ways to make that income more tax efficient in some cases than others. So investment portfolios do provide for opportunity for more tax efficient growth and more tax efficient form of income in one type of a portfolio versus the other. So again, talk to your advisor. Will help find the best solution specifically for you. But in short, yes, it is possible. Second half of the question, can we continue with appreciation? Absolutely. Again, you have a principal amount, you have some growth, you possibly taken some of the growth out in the form of an income, which shows the principal, and the principal may continue to grow. Quite often, your plan may need to have not just a big pool of money that is doing exactly the same thing. It may be laddered to some extent, more income producing portion of your portfolio, more growth oriented, more long-term growth oriented. Between different parts of the investment recommendation that comes as a final piece in the plan, there is a way to provide for both income and capital appreciation and take it from there. Another question is, Where does it lead you? What is your goal? Maybe it ties into, I worked hard for my money, I want to use it before I die. Or I have a legacy goal, I want to have this much money go to my family or my charity. So with that piece in mind, it's quite easy to navigate the investment recommendation, either with a rental portfolio, the properties portfolio, or the investment portfolio. But again, you need to know your goal first and foremost.
So we'll go over your questions now. And as a thank you for attending our presentation today, we will be drawing for a $100 gift card to a local business in the Winners area. So stay tuned for that. And a reminder, our next webinar on May 4th, we'll have Charles St. Arnaud, Chief Economist from Credit Union Central Alberta, doing a presentation on the federal budget and economic update. Just a reminder of our disclaimers here again. And we thank you so much for attending today. Everyone have a great day.